Forget what you're hearing on the news for a minute. Forget the endless debates about interest rates, the frantic headlines about inflation, and yes, even the complex charts of the inverted yield curve that every pundit loves to point to as a sign of impending doom. For decades, we've all been trained to watch a kind of financial theater, a show that plays out before every potential downturn. But what if most of it is just noise? What if the most reliable warning sign of a major market meltdown isn't something debated daily on TV? What if it's a powerful, almost silent duo of economic forces that top researchers watch while the rest of the world is told to look somewhere else? This isn't a theory or speculation. This is about a pattern, a combination of two specific signals that has shown up right before the biggest financial disasters of our lifetime. These are the signals that separate the truth from the noise, and understanding them is the key to seeing what's really coming. The mainstream financial media is designed to keep you glued to your screen, cycling through a loop of fear and greed. It thrives on complexity and minute by minute updates. But the truth is, the conditions for a crisis don't just appear overnight. As one groundbreaking study put it, they are slow to develop. They build over years, driven by deep currents in the economy that most people ignore until it's far too late. In this video, we're going to pull back the curtain. We'll ignore the talking heads and look at the actual research that has identified the two combined signals that precede almost every major market meltdown. This isn't my opinion. This is what the data says. And it's the one indicator born from two parts that you really need to be watching. Before we get to the two signals, we have to understand why they've been kept out of the spotlight. It comes down to a phenomenon I call the Great Misdirection. The financial world is full of indicators that are popular and easy to understand, but often lack true predictive power on their own. Let's take the most famous one, the inverted yield curve. That's when short-term government bonds pay more than long-term bonds. The theory goes that it signals a lack of confidence in the future. Now, we have to be fair. This indicator has a stellar track record of preceding recessions. Since 1960, a specific type of inversion has preceded every single US recession, with only one false positive back in 1966, so it's clearly powerful. But here's the issue. A recession and a systemic financial meltdown are two very different beasts. A recession can be a mild slowdown with a 15% market correction. A financial crisis, like in 2000 or 2008, is a brutal, wealth-destroying collapse. The yield curve is a fantastic recession indicator, but it doesn't have the specificity to reliably predict the timing or severity of these catastrophic market events. In fact, the longest yield curve inversion in modern history, from October 2022 until the fall of 2024, didn't result in a recession at all, which shows that even the most reliable signals can be tricky. The same goes for inflation, employment numbers, and GDP growth. They're mostly lagging indicators. They tell you where the economy is or where it has just been, not where the systemic risk is building. Watching them to predict a crash is like trying to drive by looking only in the rearview mirror. This is the Great Misdirection. The focus stays on these frequent, easily digestible metrics because they generate clicks and create a constant sense of urgency. But the real risk, the kind that leads to generational wealth destruction, builds quietly in a place most people aren't told to look. The first signal isn't a number you'll see flashed on your screen every morning. It is rapid, sustained credit growth. Let's be clear what this means. We aren't talking about a small jump in holiday credit card spending. We are talking about a massive system-wide expansion of debt taken on by households and businesses. Think of it as the fuel for a wildfire. Without it, a speculative mania can't truly ignite. The foundational research here comes from economists Moritz Schullerich and Alan M. Taylor. In their landmark 2012 paper, Credit Booms Gone Bust, they analyzed over 140 years of data across 14 countries. Their conclusion was crystal clear. Massive credit growth is one of the most powerful predictors of financial crises. They found that when debt expands far more quickly than the economy itself, it's a flashing red light that lending standards are getting dangerously loose. Think about how this plays out. In a normal economy, banks lend money carefully. But during a credit boom, that discipline vanishes. The sheer volume of money flooding the system creates intense competition. To win business, lenders start cutting corners. Lower interest rates, smaller down payments, and loans to increasingly risky borrowers. Money becomes cheap and easy. For corporations, this means borrowing billions for speculative buyouts or to buy back their own stock at inflated prices. For households, it means getting a mortgage suddenly becomes incredibly easy. The entire system begins running on a wave of borrowed money. This is the first signal. the slow, steady rise of the financial tide. But it's still only half of the equation. That tidal wave of cheap money has to go somewhere. And that brings us to the second, more visible signal. If rapid credit growth is the fuel, the second signal is the fire itself. Sharp and accelerating asset price increases. This is the part of the cycle everyone sees but often misinterprets. It's the bubble. This is when the prices of stocks, real estate, or other assets completely detach from their real world value. That tidal wave of newly created credit floods into these markets, pushing prices to dizzying heights. What happens next is a psychological chain reaction supercharged by cheap debt. It starts simply. A sector, say technology or housing, starts doing well. As prices rise, it gets more attention. The media celebrates the new paradigm. Early investors are hailed as geniuses. And that's when the fear of missing out, FOMO, kicks in. People see their neighbors getting rich flipping houses or hear stories of friends making a fortune on some hot new stock. Sober analysis is replaced by pure momentum. It keeps going up, so it must be a good investment. This is where the credit tsunami merges with the asset price fire. People who wouldn't normally invest are now desperate to get in. And thanks to the lax lending standards, they can. They take out home equity loans to buy stocks or get risky mortgages to buy properties they can't truly afford. Meanwhile, corporations flush with cheap debt use it to buy back their own shares, which artificially inflates their earnings per share and pushes their stock price even higher. It becomes a self-fulfilling prophecy. More credit leads to higher asset prices, and those higher asset prices are then used as collateral to borrow even more money. This is exactly what economists Claudio Borio and Philip Lowe identified in a landmark 2002 paper, arguing that the combination of rapid credit growth and soaring asset prices was the most reliable indicator of future financial trouble. So what happens when you pour the fuel on the fire? This is the core of it all. The single most reliable indicator of a coming market meltdown is not one or the other. It is the joint occurrence of rapid credit growth and sharp asset price increases. When these two forces combine, they create a feedback loop of systemic risk that is almost impossible to stop. This was the stunning conclusion of a 2020 paper from Harvard University by Robin Greenwood, Samuel Hansen, and Jeremy Stein called Predictable Financial Crises. They analyzed decades of data from 42 countries and confirmed that major crises are, in their words, substantially predictable. They're not random bolts from the sky, but the result of a credit boom getting out of control. Here is their most critical finding. In normal times, the probability of a country entering a financial crisis within 3 years is about 7%. But when they identified periods where both rapid credit growth and rapid asset price growth were happening at the same time, a state they call the R zone or red zone, that probability skyrocketed. When business credit and stock prices were booming together, the probability of a financial crisis within 3 years jumped to an astonishing 45%. When household credit and home prices were booming together, the crisis probability was a similarly terrifying 37%. Let that sink in. These two signals together increase the odds of a financial disaster by a factor of 5 to 6. It moves from a remote risk to a near coin flip. Why is this combination so potent? Because it creates a vicious cycle. Easy credit fuels demand for assets, pushing prices up. Higher asset prices make everyone feel wealthier, encouraging them to borrow more. Crucially, those inflated assets are then used as collateral for even more loans. This new credit is then plowed right back into the asset markets, pushing prices even higher. The entire system becomes incredibly fragile, built on the assumption that asset prices only go up. The moment they stop rising, the music stops. As prices dip, the process goes into a brutal reverse. Loans go underwater, lenders panic, and forced selling begins, triggering a cascade of defaults that can bring the whole system down. It's not magic, it's mechanics. If you're finding this analysis valuable and want more deep dives that cut through the mainstream noise, make sure you subscribe to the channel and hit the notification bell so you don't miss what's next. A framework is only useful if it holds up in the real world. So let's apply our two signals to the biggest meltdowns of the modern era. Case study 1, the dot-com bubble, 1998 to 2000. Remember the late 90s? The narrative was the new economy, and any company with a dot-com in its name was destined for greatness. Let's check our signals. Signal 1, rapid credit growth, absolutely. This was a boom in business credit. Venture capital and corporate debt were thrown at tech startups with little more than a business plan on a napkin. Companies with zero revenue raised hundreds of millions of dollars. Signal 2, soaring asset prices? This one's obvious. The NASDAQ index went from under 1,500 in late 1998 to over 5,000 by March of 2000. It was a vertical launch. People invented new metrics like price to eyeballs to justify the mania. The twin sirens were screaming. A massive expansion of corporate credit was fueling a historic bubble in tech stocks. When it burst, the NASDAQ lost nearly 80% of its value, billions in wealth vanished, and the economy tipped into recession. The pattern held. Case study 2, the global financial crisis, 2004 to 2008. This is the textbook example. This time, the bubble wasn't in tech stocks, it was in real estate. Signal 1, rapid credit growth. The credit expansion before 2008 was one of the largest in history, centered on household credit. The financial industry invented a whole new language of risky debt: subprime mortgages, interest-only loans, and no-doc loans. The entire mortgage market became a credit factory running at full tilt. The United States was, as the Greenwood study pointed out, deep in the household R zone from 2002 to 2006. Signal 2, soaring asset prices. All this borrowed money flooded the housing market. From 2000 to 2006, national home prices nearly doubled. In hotspots like California and Florida, they tripled. The mantra was real estate never goes down. Again, the twin sirens were blaring for years. A historic expansion of household debt was fueling an unprecedented bubble in real estate. When home prices finally peaked and began to fall, the entire house of cards collapsed, triggering the worst financial meltdown since the Great Depression. The pattern held perfectly. So what's the takeaway here? This isn't about creating fear, it's about providing clarity. It's about giving you a more powerful lens to view the financial world. First, this is not a tool for perfectly timing the market. The research is clear that these signals can flash red for 2 or 3 years before a crisis hits. Trying to sell at the exact top and buy at the bottom is a fool's errand. The goal isn't to be a market timer, but to be a better risk manager. So how can you use this? Start by learning to ignore the daily noise. Instead, pay attention to the big picture. Once a quarter, look up the data on private credit growth. Organizations like the Bank for International Settlements track this. A great metric is the credit to GDP gap. Then, look at the long-term charts of the S&P 500 and national home prices. Are they in a steady uptrend, or are they going vertical? Are valuations stretched to historic highs? When you see one of these signals flashing, be aware. When you see both, when you see rapid debt expansion fueling a speculative price surge, that is the time to become cautious. It doesn't mean you panic and sell everything. It means you review your portfolio. Are you overexposed to the most speculative parts of the market? Is your financial plan built to withstand a serious downturn? This knowledge gives you the power to be proactive and ensure you aren't caught by surprise when the cycle inevitably turns. This is about shifting your mindset from a gambler trying to predict the next move to a strategist who recognizes the long-term patterns of risk. We've been told that financial crises are unpredictable, black swan events that no one could see coming. But the academic evidence tells a very different story. The data is clear. Major market meltdowns are not random. They are the predictable byproduct of a credit-fueled boom. Forget the daily inflation reports and the minute-by-minute drama. The ultimate warning sign is the toxic combination of a tsunami of easy credit and a speculative mania in asset prices. When you see those twin sirens flashing, you know the risk of a crisis is no longer a distant possibility, but a clear and present danger. The power of this knowledge isn't in predicting the exact day the market will turn. The power is in understanding the environment you're in. It allows you to see through the noise, identify when the system is truly fragile, and make rational, informed decisions for your own financial future. So watch the signals, understand the cycle, and be prepared. Thank you for watching. If you want to continue learning about the data-driven realities of the financial markets, make sure you're subscribed. Until next time.